Fixed versus variable expenses. What can you control? Hey there, and welcome back to Read to Build, the show where we turn money confusion into money confidence. One honest conversation at a time. Whatever you are listening from today, whether you are working, commuting, cooking dinner, or just lying back with your eyes closed, I want you to picture your monthly bank statement in your head for a second. All those little charges, big charges, subscriptions, bills, groceries, coffee runs, it looks messy, right? Like a pile of numbers with no order. But there's the secret almost nobody tells you clearly. Every single expense you have falls into one of two buckets. One bucket you can barely touch, the other bucket you can shrink, reshape, and control almost like clay in your hands. Today we are going to sort that pile once and for all. By the end of this episode, you will know exactly which expenses are locked in stone, which ones are flexible, and most importantly, where your real power to save money actually lives. Let's get into it. Point number one, what exactly are fixed in expenses? Let's start with the bucket that doesn't move much. Fixed expenses. These are the payments that show up every single month, usually for the same amount, whether you feel like paying them or not. Think of rent or a mortgage payment, a car loan installment, insurance premiums, school tuition, or a gym membership you signed a contract for. The defining feature of a fixed expense is not just that repeats, it's that the amount is locked in by an agreement, and skipping it usually comes with real consequences like late fees, damaged credit, or even losing your home. Imagine Maria, a nurse in Manila. Every month, without fail, 12,000 pieces leaves her account for rent on the first day of the month. She doesn't negotiate it in the moment. She doesn't decide to pay less because groceries were expensive that week. It's a simply due, like clockwork. Fixed expenses are the skeleton of your financial life. They give your budget structure, but they also give it rigidity. And that rigidity is exactly why we need to understand them clearly before we talk about anything else. Because you cannot build a smart budget on a shaky understanding of what you are actually obligated to pay. Next, point number two, what exactly are variable expenses? Now let's flip to the other bucket, variable expenses. These are the costs that change from month to month, sometimes even from day to day. Based on your choices and your circumstances, groceries, dining out, clothing, entertainment, ride hailing trips, weekend outings, gifts, hobbies, all of these swing up and down depending on how you live your life in any given month. Take Daniel, a university student in Lagos. In one month, he might spend $40 on eating out with friends. The next month, if he's saving for a trip, that number could drop to $10 without breaking any contract or facing any penalty. Nobody sends him a warning letter for spending less on show that month. This is the fundamental difference. Variable expenses respond directly to your behavior, your discipline, and your priorities. They are not written into contract. They are written into your daily decisions. And because they are shaped by choice rather than obligation. This bucket is where flexibility lives and where opportunity quietly hides in plain sight. Next, point number three, why this distinction is the foundation of real budgeting. Here's why separating these two buckets actually matters. Beyond just vocabulary, most people look at their bank statement and feel one way of stress, as if every expense is equally threatening and equally uncontrollable. But that's simply not true. And that false belief is what causes so many people to freeze instead of act. Once you clearly label each expense as fixed or variable, something shifts mentally. You stop trying to shrink your rent through willpower and you stop ignoring the fact that your food delivery habit is actually negotiable. Consider Priya in Toronto, who used to feel overwhelmed every time she opened her banking app. The moment she highlighted her fixed expenses in one color and her variable ones in another, her stress dropped almost instantly because now she could see exactly where she had room to move. This is the foundation of every effective budgeting method you have ever heard of. The envelope system, the 50-30 rule, zero based budgeting, they all start with this exact same sorting exercise. You cannot manage what you have not first identified. Next, point number 4, the gray zone, semi variable expenses. Now, life is not always black and white, and your expenses are not either. There's third category hiding in between called semi variable expenses, and understanding it prevents a lot of confusion. These are bills that have a fixed base but a flexible portion on top. Think of your electricity bill, your phone plan, or your water bill. You always pay something because the service exists and there's often a minimum charge, but the total amount shifts based on your usage. Take Ahmed Dario, whose electricity bill has a fixed connection fee every month, but the total swings noticeably higher in summer. When his air conditioner runs constantly, he can't eliminate the bill entirely, but he absolutely can influence its size through his habits. Shorter showers, unplugging devices, using fans during cooler hours. Recognizing semi-variable expenses stops you from mistakenly filing them as completely fixed and giving up on them, when in reality, part of what that bill is still yours on ship. This gray zone is often where people accidentally waste the money simply because they assumed it was untouchable. Next, point number 5, fixed expenses are not as permanent as they feel. Here's the truth that surprises a lot of people. Fixed doesn't mean frozen forever. It means fixed for now. Under your current agreement, many fixed expenses can actually be renegotiated, refinanced, or replaced if you are willing to do a little homework and have a few uncomfortable conversations. Insurance premiums can often be lowered by shopping around or bundling policies. Loan interest rates can sometimes be refinanced to a better rate. Even rent in certain markets can be negotiated when a lease renews. Take James, a small business owner in Manchester, who called his insurance provider after 2 years of automatic renewals and simply asked if there was a better rate available. Within 15 minutes, his monthly premium dropped by 18%, just because he asked a question most people never bother asking. This does not mean every fixed expense is negotiable, and some genuinely are not. But treating all fixed costs are permanently untouchable closes a door that's often only stuck, not locked. A little friction and a phone call can sometimes save you more than months of cutting coffee. Next, point number 6, why variable expenses are your fastest lever for saving. This brings us to the heart of today's episode. Why variable expenses are genuinely the fastest path to saving more money. Fixed expenses require big, slow moves, switching apartments, refinancing a loan, changing providers. These take time, paperwork, and sometimes months to see results. Variable expenses, on the other hand, can change today in this very hour with a single decision. If you decide to cook at home tonight instead of ordering delivery, you will, you will already change your monthly outcome immediately with zero contracts involved. Think about Sophia in Sao Paulo, who realized she was spending close to 200 Rias a month on small impulse purchases at the convenience stores. She didn't need a new job or new apartment to fix that. She simply started keeping a small snack bag at home and noticed the habit fade within 3 weeks, freeing up real money almost instantly. This is the quiet power of variable expenses. They respond to you in real time, which makes them the most immediate, most flexible, and honestly the most forgiving place to practice financial discipline, especially when you are just getting started. Next, point number 7, the hidden trap, lifestyle creep in variable spending. But there's a trap hiding inside this flexibility, and it's called lifestyle creep. Because variable expenses are so easy to adjust, they are also incredibly easy to quietly inflate without noticing. Especially when your income grows, you get a rise, and suddenly your weekend outings get a little fancier. Your subscriptions multiply, your food delivery becomes a habit instead of a treat. None of these individual choices feel dangerous in the moment. That's exactly what makes lifestyle creep so sneaky. Consider Tom in Sydney, who got a solid promotion last year. His salary rose by 15%, but somehow his saving rate stayed exactly the same. because his variable spending quietly absorbed every extra dollar through small upgrades he barely registered. This is why awareness matters more than restriction. The goal is not to punish yourself and eliminate every joy from your life. It's to notice when flexible spending is drifting upward without your permission, and to make sure your lifestyle grows a little slower than your income does. So that gap between the two becomes your savings. Next, point number 8, a simple technique to see your own split clearly. So, how do you actually apply all this to your income, your and own life? Start with a simple technique. Take your last 1 to 3 months of spending and physically sort every single transaction into two columns, fixed and variable. You can do this on paper, in a notebook, or in a basic spreadsheet. And you don't need any fancy app to begin. Once it's sorted, add up each column separately and calculate what percentage of your total spending falls into each bucket. Take Chidi in Nairobi, who did exactly this exercise for the first time and discovered that 60% of his money went to fixed expenses, but remaining 40% is variable spending was actually larger than he didn't ever guessed. And it was scattered across dozens of tiny purchases he barely remembered making. That single exercise gave him more clarity in 20 minutes than months of vague worrying ever had. This is a technique anyone can repeat every single month, regardless of income level or country, because it doesn't require special tools, just honesty, a bit of time, and willingness to actually look at the numbers instead of guessing them. Next, point number 9, turning awareness into a system, like the envelope method. Once you earn clearly see your fixed and variable expenses side by side, the next step is turning that awareness into an actual system, something we will talk about before on this channel with the money envelope method. This the idea is simple. Your fixed expenses are get paid first because they are non-negotiable, and whenever remains gets divided into clear categories or envelopes for your variable spending. Groceries, entertainment, transport, personal care. When one envelope runs slow, that's your signal to slow down in that specific area, not to borrow silently from another category and lost track. Remember, Priya from Tornado from earlier in this episode. After sorting her expenses, he set up 4 simple envelopes for her variable spending and gave herself a monthly limit for each one. Within 2 months, her savings rate nearly doubled, not because he earned more, but because her variable spending finally had visible boundaries instead of vanishing invisible across the month. This is what turns a one-time realization into lasting habit, a repeatable structure that protects your progress even on days when motivation runs low. Next, point number 10, control over variable expenses is control over your future. Let's bring this all together with biggest picture, because this is not really about groceries or coffee or delivery apps at all. It's about freedom. Every dollar, peso, rupee or pound you reclaim from unnecessary variable spending does not just disappear into savings. It becomes fuel for something bigger. It can become your emergency fund, the down payment on your home, the start of an investment portfolio, or simply the breathing room that lets you sleep peacefully at night. Think back to every person we will mention today: Maria, Daniel, Priya, Ahmed, James, Sophia, Tom, City. Each of them found real measurable progress not by earning dramatically more money, but by understanding exactly where their control actually lived. Your fixed expenses will always exist in some form. That's simply the cost of living a life with a roof over your head and the commitments you have chosen. But your variable expenses are your daily vote for the future you want. Every time you choose intentionally instead of automatically, you are not just saving money in that moment. You are building the version of your life where money finally works for you instead of the other way around. Next, finally, and that brings us to the end of the today's episode. Let's do a quick recap in one sentence. Fixed expenses are your obligations, variable expenses are your opportunities. And the fastest path to saving more money runs directly to that second bucket. Before you go, try this simple challenge this week. Sort just 7 days of your spending into fixed and variable, and notice one variable expense you could comfortably trim without feeling any real loss. That's it. That's the whole exercise, and it might just be the start of something bigger. If this episode gave you a little more clarity today, share it with someone who's been feeling overwhelmed by their own budget. Hit that subscribe button so you never miss an episode. And drop a comment telling me which bucket surprised you the most once you actually looked closely. Until next time, this has been Ready to Build. Keep learning, keep building, and I will talk to you soon. Thank you.